Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the gold, silver, and copper markets, as well as the US dollar index for Monday, November 15th. Starting off here with a daily log scale chart of the gold market. The technical gist of the matter really comes down to the matter of scale. Indeed, across the entire metals spectrum, you can see the past few months' latest phase of the secular bull trend that dates back years. And on this scale, a failure below the October 22nd low at 1315.60 really remains required to break this long-term bull trend and expose a larger degree correction or reversal lower. In this regard, the past week's setback is considered a smaller degree corrective hiccup within that broader bull trend. Moving to an intraday 4-hourly chart, midweek last week on the initial failure below the 1386 corrective low from last Monday, the market confirmed a short-term bearish divergence in momentum that was reinforced with Friday's ultimate break of the initial counter trend low at 1382.20 that confirmed at least the intermediate term trend is down. And while we strongly suspect this is a corrective setback within the broader bull trend, we need the market to produce the strength needed to stem this recent sell-off, this short-term downtrend, and to define a more objective low. We've earmarked the 1357 level. That's the 61.8% retrace of the latest phase of the bull from October 22nd's 1315 low up to the November 9th high at 1424. But we never rely on merely derived technical levels like Fibonacci relationships to stand in front of a trend, even a short-term trend like this. We need a confirmed bullish divergence in short-term momentum to define a more objective low and risk parameter from which to rebase a bullish exposure. And in lieu of such a divergence, we would require strength above at least former near-term support turned resistance around this 1382 area, and certainly a break above Thursday's 1417.60 high will confirm this sell-off attempt as a three-wave and thus bull market corrective sequence. So for shorter-term traders with tighter risk profiles, a neutral sideline position is advised, but for longer-term traders, we still believe that a break below the 1315.60 low from October 22nd is required to have them neutralize a bullish policy and move to a neutral sideline position. These issues considered, we also want to touch briefly at this point on the inverse correlation between the metals markets and the US dollar index. In this 2-hour and 40-minute scale chart, you can see the gold and silver markets here versus an inverted chart of the US dollar index. Since they are acting in concert for the most part, it reinforces the inverse correlation between the gold and silver markets and the US dollar index. And indeed, you can see here, with the exception of a few aberrant moves, the correlation between the US dollar index and the metals markets is fairly negative. So we also, if we're trading metals, want to keep one eye on what the US dollar index, and we'll discuss the technicals of that index momentarily. Moving to the silver market, and as with the gold, the secular bull trend remains well intact, with a failure below at least former resistance turned support from the $25 area required to even defer this secular bull trend, let alone threaten it. And we really believe a failure below the 2284 corrective low from October 22nd is required to reverse this secular bull trend. And in that regard, and as with gold, we're approaching this sell-off, this recent sell-off attempt over the past week, as an interim corrective buying opportunity. Moving to a 4-hourly chart shown here, you can see the initial counter trend, short-term failure below the 2651.5 level from minor corrective low from last Monday. The market on Friday followed up with a break of that initial counter trend break at 2641.5 to reinforce at least the intermediate term trend is down, and defining former 2641 area support as new resistance, and really a recovery above the 2730 corrective high from Friday morning, we believe is required to arrest this sell-off attempt and render it a three-wave and thus bull market corrective sequence. We suspect it is. Until such strength is shown, at least the intermediate term trend is down, and we got to be respectful for that. You can see the 50 and 61.8% retraces of the latest phase of the bull from 2284 to 2934, cutting across at 2588 and 2513. But as with the gold market, we never want to rely on these derived relationships to buck a trend. So for the very short short term over the next few hours or perhaps days. Lower prices should not surprise, and in that regard, shorter term traders with tighter risk profiles have been advised to move away from a bullish policy. Longer term players remain advised to maintain a bullish policy in this market with weakness below at least the 25 the figure area, and preferably 2284 required to move to a neutral sideline position. But again, we're going to be watching very closely for confirmed bullish divergence and short-term momentum needed to define a corrective low and a more objective support level and risk parameter from which to rebase bullish exposure for a resumption of the secular bull trend and new highs above 2934. And finally, looking at the copper market, you can see on a daily log scale chart here the magnitude of the secular bull trend. The market has slipped a little bit below former resistance, new support around the 390 area. But as with the other two markets, given the magnitude of this broader bull, we suspect, or we advise traders to first approach the setback attempt as a corrective sequence ahead of resumed gains. From a shorter term perspective, you can see the confirmed bearish divergence in short-term momentum with the market's failure below the last Wednesday's 394.15 low that defined last week's 408.35 high as the end of a nice five-wave Elliott wave sequence, exposing a correction of at least that portion of the secular bull. And thus far, the market has bounced nicely off the exact 61.8% retrace of that latest phase of the bull from 370.35 up to 408.35. But we'd like to see better proof of short-term strength before we can feel more comfortable and confident that overnight's low at 384.95 is a sound and reliable one that we now can use as a risk parameter to resume bullish play. For the short term, traders with tighter risk profiles, a neutral sideline position remains advised for the time being until we can take more comfort in a near-term low in support. Longer-term traders remain advised to maintain a bullish policy with weakness below the 29 OC low at 370.35 required to negate that view and warrant moving to a neutral sideline policy. And finally, moving to the US dollar index. You can see the broader bear trend the market has been in for the second part of this year, but by virtue of last week's recovery above the 78.27 corrective high from October 27th, that confirms a bullish divergence in momentum that defines that low at 75.63 as the end of a five-wave Elliott wave sequence that now we believe we must beware of a larger degree correction or reversal higher. Certainly the intermediate term trend has been proven as up, but now the market is dealing today with the 38.2% retrace at 78.57, today's high is 78.56, of the latest phase of this year's bear trend at from 83.56 down to that 75.63 low. From a shorter term perspective, shown on a 240-minute scale chart here, you can see the intermediate term trend clearly is up, with perhaps yesterday's Friday's 77.69 late corrective low as perhaps one of this market's more important technical levels, because a failure below that level specifically is required to confirm a bearish divergence in short-term momentum. If the market does fail below 77.69, whatever high is rejected and defined, it will be considered the end of at least the initial counter trend recovery ahead of an intermediate term setback, and quite possibly the end of a larger degree bear market correction ahead of a resumption of this year's broader bear trend in the US dollar index. In either one of those cases, and given the inverse relationship between the US dollar index and the metals markets, we suspect that will be supportive of the metal markets at least for the next few days to a week. But for the time being, the trend, the intermediate term trend in the US dollar is considered up. We don't want to underestimate the extent to which this market might have become vulnerable to higher prices, and until or unless weakness below at least 77.69 is proven, further and possibly accelerated US dollar gains should not surprise. And by the same token, given the inverse relationship with the metals, that should maintain at least intermediate term pressure downward on the metals markets. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.